Welcome to A Perspective on Crime, a podcast that explores contemporary research in criminology. I grew up about 5 miles from Old Trafford, the home of Manchester United. For most of my childhood, up until I left to go to university, I'd go to most home matches and the occasional away game. Before I started going with mates, I went with my dad or my uncle. We'd drive to the game and park on some side road of scrapland close to the ground. There was other parking available. Old Trafford is in the middle of a huge industrial park, and the forecourts of factories were open for match day parking for a few quid, cash only. On the walk from the car to the ground, we'd pass dirty burger vans and stalls selling knock-off scarves. The parking, the food, the merch, all seemed part of a shadow economy that thrived outside of the tight corporate controls of the football club. Food hygiene appeared to be a nice to have. Copyright law was something that was seen as an anathema, troubling the taxman, an inconvenience too far. On the surface, all these cash-only businesses were involved in tax evasion. In fact, though, everyone knew that the businesses were legit. They paid taxes. They paid more tax than their income demanded. Each and every one, from the burger van to the parking, was a vehicle through which criminal gangs of Manchester and Salford laundered huge amounts of illicit income. In my little corner of South Manchester, money laundering was taking place on an enormous scale, in plain sight and through association with one of the most recognisable sports teams in the world. Looking at the broader context though, money laundering as we understand it is a global problem. We've built vast, intricate and expensive global systems to fight it. Every time we open a bank account, transfer cash to a friend, or even just deposit a large amount of cash, we're interacting with the system. And we all agree that, in principle at least, money laundering is bad. It props up criminal enterprises, it fuels terrorism, and it erodes our economies. The question at the heart of today's episode, though, is not whether we should fight it. That's a given. The question is, are the global systems we've built to fight it actually working? Two researchers, Mirko Nazzari and Peter Reuter, have tackled this head-on in a paper titled "How Well Does the Money Laundering Control System Work?" that was published in the journal Crime and Justice. What Nazzari and Reuter provide isn't just a casual critique, but a detailed, evidence-based assessment of the entire global anti-money laundering regime. It's a system that costs hundreds of billions of dollars a year to implement and touches the lives of almost everyone on the planet. Yet, as the authors make clear, there's very little serious debate about whether it achieves what it sets out to do. In this episode, I'll walk you through their most striking findings. We'll explore the architecture of the global machine, examine the evidence for its effectiveness or lack thereof, and delve into the hidden costs and unintended consequences. To understand the paper's critique, though, we first need to understand what this system is and what it's supposed to do. The architecture of the global anti-money laundering system, or AML as it's known, is a complex web of rules, institutions and obligations that affect everyone, from the world's largest investment banks to individuals sending a few £100s back home to their families. At its core, it's designed to combat what the authors define as the process aimed at disguising the origin of the proceeds of serious crimes. Those serious crimes are what legal experts call predicate offences. Basically, any crime that generates profits from drug trafficking to fraud and is serious enough to warrant a prison sentence of more than a year. The system we have today didn't just appear overnight, though. Its origins lie in the United States during the 1970s and 80s, where it began primarily as a weapon in the war on international drug trafficking. The American government realised that if they couldn't stop the drugs from crossing the border, maybe they could stop the money from flowing back. And like so many American initiatives, it soon went global. The central player in this global effort is an organisation called the Financial Action Task Force, or FATF, which was established in 1989. You can think of the FATF as the world's anti-money laundering standard setter. It's not a legally binding body like the United Nations. It can't pass laws that all countries must obey, but it does wield enormous power through a different mechanism. It issues a set of guidelines known as the 40 Recommendations, which are effectively the global rulebook for fighting dirty money. It enforces these rules through a powerful system of naming and shaming. Countries that fail to comply with the recommendations risk being placed on the FATF public blacklist or grey list. This might not sound much, but for a nation's economy, it can be devastating. Being grey listed can make international financial transactions more expensive and complicated, and being blacklisted can effectively cut a country off from the global financial system, as the United States can block its banks from conducting transactions in US dollars. The pressure to comply, therefore, is immense. In this paper, Nazzari and Reuter outline a clear three-layered enforcement system. At the very front line are what are called obligated entities. This is a broad category that includes banks, insurance companies, estate agents, and even certain lawyers and accountants. They are the gatekeepers of the financial system. Their job is to know who their customers are, a process you might have heard as know your customer checks, and to monitor their transactions for anything that looks suspicious. If a bank employee sees something that doesn't add up, a sudden, unexplained influx of cash into an account, for example, they're legally required to file a Suspicious Activity Report, or SAR, to their National Financial Intelligence Unit, or FIU. This brings us to the second layer. In the UK, our FIU is part of the National Crime Agency. Its job is to receive the thousands upon thousands of suspicious activity reports from the banks, analyse them, and try to piece together the bigger picture. The FIU acts as a filter. It sifts through the noise to find the signals to genuine criminal activity. The most serious, credible reports are then passed on to the third and final layer, law enforcement agencies. These are the police forces and specialist agencies who take the intelligence from the FIU and launch full-blown criminal investigations, hopefully leading to arrests, prosecutions, and the seizure of criminal assets. At the heart of this entire process is the Suspicious Activity Report. It's the core mechanism by which the private sector communicates potential wrongdoing to the state. An important question this paper asks, though, is what is the system actually trying to achieve? Nazzari and Reuter point to the fascinating tension between the stated goals of the anti-money laundering regime and the implicit ones. In official documents from organisations like the US Treasury's Financial Crimes Enforcement Network, you'll see a lot of language about protecting the integrity of the financial system. But the authors are deeply sceptical of this. As they pointedly ask, what does integrity even mean when so many of the world's leading financial institutions have been implicated in massive, system-wide scandals, from fraud to market manipulation? Nazzari and Reuter see the true goal of the anti-money laundering system not to be some vague notion of integrity. It should be something much more concrete: reducing crime. The whole point, they argue, should be to make it harder and riskier for criminals to profit from their activities, thereby disrupting their operations and ultimately making society safer. With that critical distinction in mind, can we now turn to how the system should work in theory, and the author's rigorous assessment of how it actually performs in the real world? Evaluating a system designed to combat a hidden activity is, of course, incredibly difficult. Money launderers, by their very nature, don't always fill out surveys. This section of our journey, then, is an investigation into the evidence Nazzari and Reuter have gathered to judge the anti-money laundering regime's real-world impact. They begin by looking at the system's own report card, the evaluations conducted by the Financial Action Task Force itself. These are called mutual evaluation reports. A team of international experts visits a country and produces a detailed 250-page report on how well the anti-money laundering system complies with the 40 recommendations. A bad mutual evaluation report can get a country grey-listed, so the stakes are high. But the authors find a fundamental problem with these reports. They describe them as formalistic assessments focused on anti-money laundering processes rather than on outcomes. In other words, the mutual evaluation reports are brilliant at checking if a country has the right laws on the books, but they're much less interested in whether those laws are actually stopping any crime. The examples they provide are damning. In 2017, the evaluation of Denmark made no mention of a colossal scandal brewing at Danske Bank, where over €200 billion in suspicious funds had flowed through its Estonian branch. Similarly, in the 2015 report on Australia, it was given a broadly positive assessment of the country's major banks. Yet, at that very moment, two of its largest institutions, the Commonwealth Bank and the Westpac, were engaged in what the authors called a massive and persistent failure to implement basic anti-money laundering standards, involving potentially billions of laundered dollars. These aren't just minor oversights. They're failures that go to the very heart of the evaluation process's credibility. So, if the official valuations are unreliable, where can we look for better evidence? This is where the authors turn to the data. And when they plotted the two most important metrics on a single graph, the number of suspicious activity reports and the number of prosecutions, they found something just didn't make sense. On one hand, the number of suspicious activity reports filed by banks in the United States had skyrocketed. It had climbed from a little over 50,000 in 1996 to nearly 4 million in 2023, a 71-fold increase. And convictions for money laundering? You'd expect them to follow a similar trajectory. Instead, they flatlined. The gap between the two lines on the graph tells the core story of the system's failure. In 2023, for every single money laundering conviction in the US federal system, banks filed 2,904 suspicious activity reports. The authors point to this phenomenon known as defensive filing. Banks face huge fines if they fail to report a transaction that later turns out to be illicit. But there's no penalty for reporting one that just turns out to be perfectly legitimate. So, to protect themselves from liabilities, banks have an incentive to report anything remotely unusual. This practice, known as defensive filing, floods the system with a massive volume of low-quality reports, overwhelming financial investigation units who are left trying to find a needle in a haystack the size of a mountain. But to judge the system solely on money laundering convictions is to miss its main, perhaps unintended value, the true worth of this avalanche of data. It's generating intelligence. Here, the authors articulate the central irony. The system's greatest failure as a prosecutional tool is the accidental source of its greatest strength as an intelligence tool. While a single suspicious activity report might not lead directly to money laundering charges, the cumulative database can provide vital pieces to a much larger puzzle. The paper synthesises statistics showing how agencies like the FBI and the US Internal Revenue Service use this data to support a high percentage of the investigations into the huge range of other crimes. FinCEN, the US's Financial Investigations Unit, report that in 2023, its data was linked to nearly 15% of all active FBI investigations, including a third of complex financial crime cases and over a quarter of public corruption cases. So, while it may be failing to catch the money launderers per se, the system has evolved into a powerful intelligence gathering tool for law enforcement. This success in intelligence gathering, though, is overshadowed by a profound failure in another key area: seizing the proceeds of crime. The whole idea of anti-money laundering is to hit criminals where it hurts, in their wallets. Yet the paper presents some starkly striking estimates. The United Nations Office on Drugs and Crime calculated that globally, probably only around 2% of all criminal proceeds are ever seized and frozen. More recently, Interpol estimated that law enforcement in the EU manages to confiscate less than 2% of the annual profits of organised crime. This is, by any measure, a catastrophic failure. The system is simply not depriving criminals of their illicit gains. And what about the criminals themselves? Has this multi-trillion-dollar global regime forced them to become more sophisticated? The popular image is of an arms race, with law enforcement consistently trying to catch up to the ingenious methods of criminal masterminds. Nazzari and Reuter, however, argue that this is largely what they describe as an ingenuity fallacy. Citing multiple empirical studies, they find that most money laundering schemes are, in fact, surprisingly simple. Criminals aren't being forced into ever more complex methods because, for the most part, the simple, tried and tested techniques still work just fine. The verdict then is unclear. The anti-money laundering system functions as a decent, if inefficient, intelligence gathering tool for a wide variety of crimes. But on its own terms, convicting money launderers, seizing their assets and making their lives more difficult is largely failing. And that leads up to the next central question. Why is it failing so badly? To answer that, the paper looks into the systematic flaws and unintended consequences of the anti-money laundering regime. Nazzari and Reuter identify failures at every level, from the geopolitics of the Financial Action Task Force right down to the impact on individual bank customers. Their analysis reveals a system that's not just underperforming, but is in many ways broken, with its costs falling disproportionately on the innocent, while powerful actors often escape accountability. The three primary mechanisms for this failure are: number one, what they call a defection by leading nations. You would assume that the countries that created the system, like the United States and the United Kingdom, will be its most diligent champions. But the reality is quite different. Even those founding members have consistently failed to fully implement key Financial Action Task Force recommendations. For decades, the United States was criticised for a massive loophole in the system: the failure to require the disclosure of beneficial ownership. This meant you could set up an anonymous shell company in a state like Delaware or Nevada with less personal information than it takes to get a library card, making it a paradise for anyone wanting to hide illicit assets. The problem is just as acute here in the UK. Our own National Crime Agency estimates that over £100 billion is laundered through the country annually, much of it facilitated by the misuse of UK registered corporate structures. When the architects of the system fail to play by their own rules, it undermines the credibility of the entire enterprise. The second mechanism they call implementation failure. This connects back to the point we just discussed about asset seizure. Even in a country like the United Kingdom, which received a highly effective rating for confiscation in its last Financial Action Task Force evaluation, the results are shockingly poor. In recent years, annual seizures have remained below £240 million, a tiny fraction of the £100 billion estimated of laundered funds. The laws and agencies might exist on paper, but they're failing to deliver in practice. It's the third mechanism, though, that perhaps is the most damning: deliberate non-compliance by banks. The paper creates a powerful narrative, using case after shocking case of blatant, systematic and persistent rule-breaking by some of the world's biggest financial institutions. These are not isolated mistakes by a rogue junior employee. These are broad-level failures that go on for years. The authors describe the case of the NatWest here in the UK, where one client, a wholesale jeweller in Bradford with stated annual revenues of £15 million, deposited £290 million in cash over 4 years. Staff described how the money was brought into the branch in large black bin liners, so heavy that they'd often break. The cash filled the branch's floor-to-ceiling safes, yet the bank failed to file a single suspicious activity report. In other cases, The authors identify what they judge to be astonishing boldness. In the Danske Bank scandal, for instance, a company with no website, started by a 21-year-old, was found to be receiving millions of dollars from a Russian state arms company for no clear reason. Another company was buying $2 million worth of building materials from the remote British Virgin Islands. Then there's the HSBC scandal, where the bank's US arm was found to have laundered hundreds of millions of dollars from the Mexican drug cartels. What's truly astonishing is that even after these banks were caught and hit with enormous fines, HSBC paid $1.9 billion and NatWest £265 million, the behaviour often continues. The authors stress a critical point. The huge fines don't seem to work as a deterrent, and individual senior executives are almost never held criminally accountable. That brings us then to the other side of the ledger, the system's vast and often ignored costs. While the paper shows the benefits are highly questionable, the costs are enormous and undisputed. And these aren't just financial costs borne by the banks. There's a profound human cost. Nazzari and Reuter shine a light on the practice of de-risking and de-banking. De-risking is when a bank decides that the whole category of business is deemed too risky rather than assessing a customer individually. A key UK-related example they cite is when major British banks, fearing regulatory repercussions, cut off services to Somali money transferring organisations. These were vital lifelines for the Somali diaspora in the UK, sending money home to a country with no formal banking system. Suddenly, families were cut off from these essential funds. Then there's debanking, the related phenomena where ordinary individuals or small businesses find their accounts frozen or closed without warning or explanation, often simply because an algorithm has flagged them as a potential risk. In the UK, banks closed over 340,000 accounts in 2021-22, a huge increase from previous years. For people affected, this can be a devastating and bewildering experience, effectively locking them out of the modern economy. The authors identify a dangerous paradox here. These risk-averse behaviours don't eliminate illicit finance, they just push it into the shadows. De-risking can drive financial activity into completely unregulated channels, like the informal hawala system, making it even harder for law enforcement to track the funds they're supposed to be following. However, the problem doesn't just stop there. The paper details how the anti-money laundering system can be misused and weaponised by authoritarian governments to suppress political dissent. They cite examples from Serbia and Uganda, where governments use the pretext of anti-money laundering laws to demand the private financial details of non-governmental organisations and media outlets that were critical of the regime. There is a profound irony to all this. A system designed to create security and stability in the financial world has, for many innocent people, become a source of profound insecurity and harm, all while a select group of powerful actors seem to get away with breaking the rules time and time again. Nazzari and Reuters paint a picture of a global system that is buckling under the weight of its own contradictions. Synthesising their overall argument, they conclude that the global anti-money laundering regime, despite its immense scale and cost, is a largely dysfunctional regulatory system that demonstrably fails to achieve its primary goals of reducing crime and seizing illicit assets. It generates useful intelligence, yes, but at colossal cost, both financial and human. This raises the obvious question. If the system is so broken, why is there so little serious debate about fundamental reform? The authors provide a compelling explanation. They introduce the concept of plausible folk theory. This is the simple, common sense idea that fighting dirty money must in and of itself be a good thing. The issue exists, however, that by not being built on robust empirical foundations, it's supported by nothing more than a rhetorical and informed hunch. It's a belief that's easy to grasp and hard to argue against. This plausible folk theory, they suggest, acts as a powerful shield, protecting anti-money laundering systems from the kind of critical scrutiny that other major public policies face. It's a shield allowing the human costs we've discussed, the Somali families cut off from remittances, the small business owners who find their accounts frozen without explanation, to continue with almost no public scrutiny or political debate. There are other factors at play too. Powerful interests, including major banks and the governments and countries like the United States, benefit from the status quo. And the fact that the system is also tasked with countering the financing of terrorism gives it, as the authors put it, an almost sacred character, making any attempt to reform seem irresponsible and even dangerous. The paper doesn't offer a complete blueprint for a new system. It's a call to action. Nazzari and Reuter argue that it's time for criminologists and other social scientists to stop ignoring what they see as a crucially important area of public policy. They urge researchers to engage more deeply with the topic, to bring their analytical tools to bear and start asking the tough questions about effectiveness, about justice, and about the profound societal consequences of our current approach. Their work is not just an academic critique. It's an invitation to begin a debate that's long overdue. A debate about whether we can design a system that is smarter, fairer, and ultimately, I suppose, more effective at tackling the harms of organised crime. The same Wild West vendors still operate outside Old Trafford today. Most of the car parks take cards now. The merchandise is more sophisticated and is designed to sidestep copyright infringements in much the same way that Aldi does, I suppose. The vans even offer vegan options. Where the thousands and thousands of payments from the card readers end up, though, is anyone's guess. I doubt anyone's looking too closely at it. After all, we've a system in place right now that stops criminals from operating within the banking system. Right? The research paper we've discussed today is called How Well Does the Money Laundering Control System Work? It was authored by Mirko Nazzari and Peter Reuter, and you'll find it published in the journal Crime and Justice. A link to the paper, as ever, is in the show's notes, and of course, I'd urge you to read it for yourself. New episodes of A Perspective on Crime will drop every week, so make sure you subscribe and please recommend A Perspective on Crime to friends, colleagues, and anyone you think might be interested. Finally, if you've read some research you think others should know about, drop me a message via the link in the show notes. If you yourself have new work coming out and would like it covered, please get in touch. Until next time, goodbye.